Hello, and welcome to our webinar on navigating alternative investments, finding the true alternatives. This is a webinar all about alternative investments, starting with what is a true alternative investment and why family offices should consider them. Joining this discussion today are two experts, Dan Siciliano and Sebastian Rivas. Dan is CEO and co-founder of Nickel, a fintech that has invented a better way to invest in private unicorn companies. And alongside his entrepreneurial career, he was Stanford Law Professor of the Practice and Associate Dean at Stanford, and is a recognized expert in corporate strategy and governance, capital, financial markets, technological disruption, and executive compensation. Dan is currently chair of the Council of Federal Home Loan Banks. Also joining us is Sebastian Rivas. Sebastian is the founder and CEO of Andy's STR, a prop tech startup that leverages machine learning to help institutional investors invest in short-term rental real estate globally. Prior to leading Andy's STR, Sebastian worked in AWS as a senior technical product manager, and he has also worked in capital markets and investment banking and private equity. So welcome, Dan and Sebastian, for what's going to be a really great discussion. And just a bit of housekeeping before I turn it over. Feel free to ask any questions in the Q&A box. I'll be curating those and sending them to our panelists for answering. So do that at any time. I'll be looking for those. And with that, I'll turn it over to Dan and Sebastian.
Great. Thanks very much, Kathy. Super excited to have a chance to chat about one of our favorite topics. Only geeky finance people who live in this space would say that this is one of their favorite topics, but I think it's one of the most important topics for investors, institutional investors, family offices, and others. So I'm glad we have Sebastian with us. And maybe I'll kick it off by posing, it's probably something a lot of people have heard when they hear any pitch about compound, returns. The compounding of financial returns is often referred to as the, depending who you're talking to, eighth or ninth miracle of the world. And I'll start with the idea that, as we know, that Manhattan, the island, was purchased from the indigenous native peoples, and if you follow the history, which is a little disputed, they were given a set of trinkets worth about $24 at the time in 1626. In exchange for signing over the rights to the island of Manhattan. Now, there's lots of implications there, which we're not going to go down that road, but let's just take it at face value and say, hey, if you had that cash, 24 bucks, was that such a terrible deal? Well, if you compounded it at, real rates of return of say 4.5% or 5%, so call it, anywhere from 6 to 8% across time, you came to now, you'd have several trillions of dollars. It always surprises people. If you double something for long enough, it actually ends up being a big number, and it'd be worth more than the estimated total value of Manhattan. So why is it not the case, therefore, that family offices, institutional investors just don't take the big bulk of their wealth and park it somewhere where it'll just get some pretty good returns over time? If you're willing to be generational about it, you don't have to be impatient about getting 10 or 15 or 20% returns that are compounded. Well, here's the problem. That's going to be the essence of what we'll talk about. Any given asset class that provides consistent returns that are real returns on a risk-adjusted basis grows, and over time it becomes efficient. And as it becomes efficient, more capital flows in. As more capital flows in the end, then your returns are reduced. And that's not even considering exogenous startling risk. So, Sebastian, why don't I have you kind of jump in and give us maybe your traditional, since you come from such an excellent traditional school in terms of Chicago Booth, GSB. What is the traditional definition of alternative assets overall? And it doesn't have to be formal. I'm just curious, like if you were just having a casual conversation, and then let's pick it apart and talk about what the new thinking should be, and give people some very practical questions to ask and things to look for. But give us the kind of University of Chicago approved definition, and then let's take it real world.
Yeah, for sure. Thank you. So I don't know the exact definition per se, but what I can tell you is kind of how, like, the more practical definition, because I think it's highly debated. Some people use trading cards, by the way, like baseball trading cards as an example of alternative investments, which could be, but I don't think capital markets, it looks very looking like. So generally speaking, we talk about alternatives when you mention a less liquid and less efficient asset class. More often than not in a niche sector where managers can actually drive an outsized portion of the returns, which is kind of weird because usually if you follow kind of efficient markets, David Swenson's school of thought. Managers, they can do a really good job, but it's very hard to beat the market consistently over time, right? So in the alternative space, that still holds true for sure, but you can generate historically anywhere between 300 and 500 beeps extra spread over the public markets just by virtue of basically, or a way to explain it is getting less liquidity, right? Like you have duration risk. So you're taking an extra risk. It's not necessarily an arbitration opportunity, because you have to be very skeptical about those, generally speaking. But given that there's less liquidity, that there are risks that the market does not know how to price very well, because it's just a more niche asset class, it's something that's less understood. The marginal dollar that, in terms of investors, that gets into the asset class tends to have a different cost of capital, right? And if you have, entrepreneurs or projects that want to get funded, well, they have to bite the bullet, generally speaking, and therefore can provide better returns to the investors. So that's generally how the market sees that asset class.
Great. I think that's a great introduction to it. Let me tease out a couple things. And I think you gave the both technically correct and kind of practical on the ground view. So first, in reality, why would someone be turning to quote unquote alternative asset classes? And I think Swenson, really, who we lost this last year, very sadly, he was the early institutional investor advisor and kind of economist who was fundamentally applied, working away at doing amazing things, who identified the fact that what you're really looking for is better return. So arguably, though he defined it differently, alpha. So you're looking for something that gives you a little extra without having to take on risk necessarily. So that was the first. So you're looking for special risk adjusted returns. And then perhaps, and this often gets conflated, you're looking for uncorrelated returns. So, the traditional definitions of hedge funds, alternative asset classes have all gotten blurred in the last 20 years. But when you talk to people who say, yeah, I'm looking to allocate more into alternatives, what they end up tending to say is, I'm looking for, returns that are different from my other portfolio, whether it's, bond, equities, and some combination, and that I'm hoping to get a little quote unquote extra. Now, let's delve into that extra. Here's a specific question. The liquidity risk itself. So when you have this liquidity reduction in most alternative asset classes, why is that sometimes a cost to some investors and not as big of a cost to other investors? And maybe we are in this case defining who it's a good fit for to think about it's okay to have this lack of liquidity. So maybe give us a little bit of your view on that, the investors who can tolerate the lack of liquidity. And if you can tolerate it, does that remove the risk that the liquidity constraints present, or does it just make it more bearable?
Yeah, no, it's a good question. So it's a big topic as well, but what I've seen in my career is that there's two sources of two really good natural fits. One, and I think the more, maybe the less talked about one, but very important, is folks that basically want to match, long-term liabilities with long-term returns, right? Those are very natural fits, and that's usually like, for instance, life insurance companies investing in infrastructure bonds, for instance, stuff like that, where you can, those are highly structured, long duration, definitely super alternative. There's no super liquid market, generally speaking, for them, but you can match long-term liabilities because you need to, pay out certain, amounts of funds to your the people that are providing money to the fund, but also you need to find a way of generating those like matching those liabilities with those long-term sources of funds. That's
let me clarify that. So that means that the duration risk, arguably, so the risk that you have where you've locked in a rate of return and you can't liquidate over time, and in the intermediate periods of time, the normal rates of return or the risk-free rate of return fluctuates up or down. So the value of your kind of long enduring asset changes, right? If you have a match to the need for that, then in reality, while it is true that the fundamental value of the asset may be changing over time because of changes in rates, for you have satisfied the goal and you have essentially de-risked it, so long as that's true. So again, to say, liquidity constraints are a problem if you might need liquidity. If you truly believe you don't need liquidity, for you, the fundamental precepts of finance still apply, but you get to, as we tend to say in banking anyway, you actually get to hold to maturity, right? So you get to, and then whether it's 5 years or 10 years or 15 years, and the 5 and 7 and 10 years are a common lockup reality for most vehicles that are investing in alternative asset classes, whether it's a private equity fund or venture capital fund. We can talk about others, but that's the first insight is, do you believe that you need the liquidity? If the answer is no, I do not, then you've opened up an entire new set of potential returns that other folks are discounting because they might need liquidity. So it's a real risk. And if it's not a risk for you, that's an opportunity. So that's our first, and I think this will be fairly obvious to most, but I don't think investment advisors, institutional investors sometimes speak of it with clarity, which is if you have a different liquidity need and or you can insure in another way against your intermediate liquidity needs, you have created an opportunity to bear a technical risk, which is not damaging to you, and you can get returns other people can't. So that's like our first, how to sort the signal from the noise. Ask that question of yourself and then decide how much time you can lock up your cash and assets.
Exactly. And actually a different way of saying the same thing is, if you look at portfolio theory, you want to hopefully get to the same level of return. You want to have like negatively correlated, if possible, right, risks with your current portfolio. Well, it's the same thing. If you have a certain kind of need for certain liabilities, right, you can see that as a negative return in a sense, and you want to have something that basically correlates exactly negative with that while adding returns. So basically a source of funds in the long term. So as long as a portfolio, you kind of cancel out that need for liquidity, great. Then everything else is just in a sense alpha, right? That could be construed as alpha. Exactly. And the other segment I think is, as you kind of pointed out before, is folks that care about long-term absolute returns, right? I think historically speaking, there's just no better way of deriving long-term absolute returns than by taking, quote unquote duration risk. But again, risk just as value depends on the beholder, right? It really does. So if I, as you were saying before, if I have a way of paying for my current liabilities or current, needs, do you actually need that extra liquidity? Is it like something that adds a lot of value? Because sometimes people just focus too much on the axioms of like, well, yes, cash is king and you want more liquidity now, but that's it, because there's a trade-off, right? Like more liquidity now means less, return in the long run. So what are you solving for? And usually family offices can solve for generational wealth. That's kind of the point of setting up a family office, right? Making sure that your next generation is going to be well off. So if you can maximize for the next 30 years, the answer, the solution is not going to be the same as if you're trying to maximize your return over the next 5 years, right? Even risk adjusted. And generally speaking, alternatives are a really good way of maximizing for the long run.
So let me jump in and first, kind of a source for people who are paying attention to this and are interested in things that we're bringing up, and anything that I flag as, hey, there's work on this in the academic world and some folks are applying it, but it's not getting the attention it needs. It's not hard to go digging into the academic side of this if you want it. And I'm going to suggest and we'll send this to everyone who's on the webinar, ssrn.com. So Social Science Research Network is a robust working paper arena, which has been around for a long time now, but is, the last 10 years been professionalized. And there's a lot of great working papers that come from some of the very best and some of the up and coming academics worldwide that show up there. And they have different categories: corporate governance, finance, applied finance, et cetera. So one of the things that hasn't gotten a lot of attention, and is a theory that I worked with while at Stanford, is that we just identified liquidity premiums, the ability to identify, matching for timeframes and take advantage of that. Here's another interesting point. The markets are always seeking ways to create liquidity where there is liquidity scarcity, right? There's a return on that, right? You get a liquidity premium. So it's always worthwhile if you can take something that is illiquid and make it a little bit more liquid, either by creating a marketplace for it, by identifying a new way of creating instruments in that space, you will do so. So the market's always pushing that direction. Here's an interesting insight. If you as an investor can bear the lack of liquidity, we know you can enter that and be smart and get the returns, but you might also think to yourself, what arenas are likely to start presenting more liquidity opportunities? So let's take an example in venture capital and private companies. Go back a generation and a half, 25 or 30 years, it was almost impossible to find what we would call intermediate liquidity for owners of private shares of venture funded companies. There were some very one-off deals, but they were so rare as to be the case that no one thought of that liquidity as liquidity. Fast forward, and over time, I would say that market is hardly liquid, but it is many times more liquid, meaning there's an ability for someone to offload their private shares in a lot of different transactions, whether it's in the secondary markets that were created, Shares Post and others that have now been merged into other entities, or just through transactions that are available. Some markets improve their liquidity over time, and that means you as an investor if you're a part of that, get to benefit from the liquidity premium that starts popping up, right, as there's more liquidity in that market. So kind of an advanced note. It's interesting. If you want to look it up on SSRN, you can Google liquidity premium emergence, and you'll find that there. So we've identified that liquidity is at the core of a lot of alternative asset decision making, why it does or might not fit, some kind of pro tips about, hey, look for things that might change. Now, we're sitting in the world of alternative assets are still defined as not equities, not bonds, not cash. Everything else is fair game. Let me ask, when does an alternative asset start to lose its when does it no longer deserve being called alternative if you're using that as a proxy for I'm looking ideally for better risk adjusted rates of return, and I'm also looking perhaps for certain uncorrelated returns? Like I've got a list of things. What happens when, say, a particular asset class as an alternative gets too big, or if it's too small? What do you have to say, Sebastian, about kind of what sometimes we refer to as the Goldilocks size of alternative asset investments, like neither too small nor too big? How does that apply? Maybe tie it to Andy's STR directly, because you guys are operating in real estate, which is sort of considered an alternative asset, but it's so big, like you have to get clear about what you mean.
Yeah, no, that's a really good question. So again, like definitions, formal definitions aside, because I don't think there's a consensus in this. Some of the red flags or things that you want to keep in mind when evaluating whether something is truly an alternative for the purposes of your portfolio, right? Semantics aside, right? I think first size, definitely size. Like if something, for instance, if you have one fund, one vehicle that exceeds 10, 20 billion, well, then there's a big question. How can the manager sustain that alpha for with that amount of money? Because like if you're talking in the many billions, well, that's kind of generating a market. That is kind of making liquidity, basically. That's more than enough money to kind of sustain many asset classes, right? So that's one. Second, as you pointed out before, you start to look at the correlations with the market. So if you look, for instance, at BREIT, for instance, size really big, really big. I believe it's now over 50 billion. It grows every time, right? It's gigantic. And then you start to look at the correlations with other markets, with other REITs, right? With very liquid, securities. There's a real correlation now, right? Like very real. So then that begs the question, like, is there a good reason, a good fundamental reason to believe that going forward, we're going to generate that premium, right? And if it's getting correlated with the public markets now, is there any reason to believe that it's not in the future? It's not, because even if you think about, like, just think big scale. If you were to invest in all of the real estate on earth, very likely that it fluctuates very similar to the business cycle, right? Because that's where you get your risk, basically, essentially, in like tenants, etc., right? So that's definitely something to keep in mind. Tied maybe to entities. Oh, go ahead.
That's perfect. I think it's a good setup. So let's get specific about what a lot of different, and again, I would say we aren't maverick in our definitions here, but we're a little bit casual about being willing to break the norms and say that is or isn't effectively an alternative asset class. So bear with us. But a common form of alternative asset class, if you just kind of look it up, is going to be real estate, as we said, but we're going to continue to further differentiate. Commodities. Cryptocurrency would be thrown out there. Collectibles, you mentioned that at the outset, with baseball cards and the like. Within kind of traditional investment in company structures, alternatives would be considered venture capital, private equity writ large. Really, VC is a subset of private equity. Reasonable people can debate that, but let's just kind of put them in the same category. Certain types of hedge funds, long, short hedge funds might be an alternative. That's kind of a financial derivative structure, but we can come back to that. And then lately, and relevant to a lot of our discussion, private credit. So private credit kind of fits into its own little bucket. So let's quickly, at least in my mind, say that commodities, cryptocurrency, it's collectibles, commodities. It's a huge market, but it tends not to represent the advantages that we just highlighted as an objective of a family office, right? So there isn't particularly a liquidity issue in commodities. It's a deep market. There's a commodities exchange. Certain commodities might have that. And it doesn't particularly present risk-adjusted return opportunities because it's really deep and it's fast-moving. There's deep expertise. You're unlikely to find some sort of premium just by stumbling upon it. It's not really an inefficient market in traditional sense. And then certainly it tends to be correlated with the macro markets. Now, certain commodities might have different relationships, but there is identifiable correlation. So those areas create, a challenge. And I think what we're really focusing on is investable assets that are neither commodities, not collectibles in this case, and we're staying away from cryptocurrency. Although, that is a perfectly eligible alternative asset, but it's just fraught with all sorts of. So let me ask a question, which is sometimes those two goals of kind of better risk-adjusted rates of return, whether alpha or not, and non-correlation, those things can work in opposition, right? So if something really is, uncorrelated, then people are going to desire it more. And if you have, capital enter the asset class, then the rate of return goes down and the like. So it raises this observation, that is, if you can find an inefficient market that's deep enough that you can access and it doesn't hit the red flags you've identified, sometimes you're better off trying to create derivatives around it to create your non-correlation or to achieve your goals about volatility, rather than trying to find an asset class that has all of those things, quote unquote, natively. So what I mean by that, and maybe I'll draw an example from Nickel. So access to private unicorns, so venture funded companies of a certain size. There's a market that's kind of cluggy and sludgy in there. And if you buy in that market, it's highly volatile, right? Because there's liquidity issues, but also, eventually those companies should be public in one way or another, or get liquidity. And it's hard to know what they're worth, right? So it bounces around a lot. If you wanted to change the volatility or to alter the way in which that value changed, you could create a derivative structure on top of it. So you can go find the alternative asset, the private company, and it has certain features and it's an inefficient market, so there's opportunity, but you couldn't at the same time, unless you put a derivative around it, solve for your volatility or correlation issues. And that's what Nickel does, right? So we do prepaid variable forward contracts with employees. So we get access to this really hard to get access to category of investments. Like the likes of us cannot simply show up and say, I'd like to be on your cap table, super cool Turo or super cool Instacart, right? They're like, yeah, there's 12 people get to be on our cap table and employees, and that's it. Sorry, right? So the only way you can really do it in a typical at scale, legitimate, compliant way is working through employees who can enter these contracts that are allowed. And that contract can have features, right? And ours happens to have a feature that has 60% downside protection. That's just a standard choice. So compare and contrast for me in the real estate space. So I just described, all right, we went to an inefficient asset class, private companies. They have lots of cool things going for them, lots of growth, but it's hard to know the value. What if you don't want the volatility? Okay, you put a derivative on it. Great. Alternative asset class with features, yay. What about in real estate? It seems like real estate, on the one hand, is just much more, you have it or you don't. It has returns. Can you talk to us about this non-correlation strategy?
Yeah.
Just the excess returns?
Absolutely. Yeah. And I love how you put it, because just in the case of Nickel, just being able to get access to unicorns is already a big part, right? It's an inefficient, like a illiquid market, but then you kind of fix for the alpha part with the derivatives, right? With the structure. So you're kind of mitigating the downside, right? Or limiting your downside while kind of keeping all of the upside. That's super smart. I like it a lot. And it parallels a lot of what we try to do in real estate with Andes, right? So Generally speaking, if you go into an asset, if you buy real estate, sure, real estate is an alternative, but it's a gigantic market. It's the largest asset class on earth, right? And it's moderately liquid, right? Depending on which side you're on, if it's single family homes, multifamily hotels, etc. Most of these kind of sub asset classes are liquid. So then that kind of means that you're probably not given that there is liquidity, not as much as or instantaneous as the capital, like typical stocks, for instance, or stuff like that, or bonds. But there is liquidity. If you want to sell a house, you don't have to wait 5 years, right? Or to maturity, right? You can do it in probably a couple of months. You may have to take a hit, but there is liquidity, and more than ever, by the way. A lot of dry powder there. And generally speaking, if you buy enough real estate, you do correlate with the markets. There is a correlation, right? So what we try to do at Andes is basically going back to the very first kind of high level definition of an alternative space. We try to find the niche within the asset class, right? So that's the first thing. And the way to do it, it's usually, it correlates a lot with inefficiencies, right? So you try to find what sector or subsector of this large asset class, which is real estate, is highly inefficient, and for a good reason, not just because, but there's a structural barrier to efficiency, to information flowing freely. In our case, it's short-term rentals, right? And the reason being, if you try to evaluate this specific property, how much money can I make throughout the year in rents if I put it on Airbnb? There's no good source of data, and that's structural. And the reason being, who manages the property is a feature. It dictates how much money can you make, right? If, no offense to my sister, but as much as I love her, if my sister starts managing short-term rentals and Airbnb properties for us, they're not going to perform as well as if a professional manager who does this for a living does it, right? They're going to do better pricing, better reviews, better cleaning, etc. And therefore you can charge more money, right? You can optimize that asset, right? So in a sense, what we're seeing, and these are one of the kind of initial thoughts was, there's this thing called real estate, which is really big. People want to go in, right? There's liquidity, but there's a sub-segment, it's a sliver, basically, it's very, very small sliver, less than 1% of the total housing stock in the US, by the way, that are short-term rentals that have this inefficiency, which is, it's just very, very hard to know, how much money can you make? What's your actual return here? So that's one big inefficiency. But on top of that, structurally, and this is very unique, and it's like stars aligned, like one of the type of things that happens once in a lifetime. On top of that, the short-term rental model, there's no real big change in the asset class itself or the asset, right? It's the same bricks and mortar, it's the same house. So basically short-term rentals as an idea, it's a free option or almost free option to get higher yields, to get more cash flow, right? So if it works out well, you get the upside. But if it doesn't work, you go and put a tenant in there, and now you get the efficient market level of return over that specific asset. So now we basically have those same two structural kind of components that we want to see in a good alternative investment. We have asymmetric risk return, which is another way of saying you get alpha, right? You get disadvantage in the long term, and you have inefficient and some sort of inefficiency that you can consistently exploit. In this case, information is just very hard to get. Right. So that's kind of what we're doing. We're using AI basically to identify these assets and then offering them to customers.
I think that's great. Let me extract the kind of takeaway points writ large for quote unquote getting through the noise of alternative asset classes. So first, I think, we're probably causing some, senior faculty at both Stanford and Chicago to shudder a little bit. We are admittedly being blasphemous as to the formal definition of alternative asset class. So set that aside for a moment and open your mind and realize, all right, so if you want to get your better than average rate risk-adjusted returns, and you want to try to achieve these objectives of non-correlation or adjusted volatility or whatever it may be. So the thing that it's not, and I think this is important because this helps you identify where people say, hey, alternative asset, we can get you into this. The thing that it's not is a traditional or very large market on which you slapped a derivative. So what I mean by that is, it is not, in fact, an alternative asset investment to have some sort of exotic derivative sitting on top of public equities. Okay. Now it can certainly be an appropriate asset. It can be a hedged asset. I mean, it can be all sorts of wonderful or terrible things. But I think we're saying that you need both an asset opportunity, which falls into that inefficient class or liquidity impaired class. It somehow has these features or bugs that create a weakness of its access to the market, or a discernibility problem, meaning people can't tell the good from the bad. So both of our markets have those features. And then you can really tune it up by actually adding what you might call derivative structures. And in your case, what you've done is you've created a better model for cash flows and lower volatility around those cash flows over time. Now, you don't think of that probably as a derivative structure on top of your asset, but I think like a theorist would. And so again, here's the takeaway. The takeaway is you need an underlying asset that sits in a world that has a bunch of inefficiencies, a bunch of clunkiness, a bunch of differences that people can't sort out easily. And then probably in the modern environment for like sophisticated investors, you need some sort of layer that's giving you these derivative features, right? So you're not just going to want to go and buy, if you could get them, shares in unicorns, right? That's not actually going to achieve your full set of objectives, because those shares in unicorns are going to be volatile in a way that is magnified relative to the regular market. So it's not only just correlated, there is causality there, actually working the opposite direction. But if public stocks go up and down a little, the private ones are going to go up and down even more. So you're not going to get any of that. And you're also not going to get some of the other components, which include, whether it's diversification across a set of those different assets and the like. So you need something that's between you and that inefficient market that creates the real alternative, quote unquote, objectives that you want. So let me ask you, why do you think we don't see more of this kind of opportunity in the marketplace for, average high net worth, ultra high net worth, and smaller institutional investors? Why don't we see more of that? And then I want to come back around to like how to go looking for more, maybe.
Yeah, well, there's a few answers, but in our world, at least in the short-term rental real estate space, first, it is very hard to get those assets. Like the deal sourcing part, it's very, very hard, right? So basically, if you have something that's good, why would you like to share it with others, right? So we see private transactions, but they are usually not available to the public, right? And there's like literally sizable fortunes that are being made out of like short-term rentals nowadays, right? Quite a few. But then again, there's generally speaking, the early adopters are not trying to explode the thing and provide access, right? Because that model itself, it's more attuned to that of a startup, right? And most folks do not run startups. Most folks either run small asset management shops, right? Either they have their syndicated deals, or they're just trying to, have a lifestyle business, which is nothing wrong with it. In fact, it's very, very good. Startups, they need to create a lot of growth, right? They need to tackle big markets. So they need to provide access to a bunch of people, not just ourselves, right? So I think that's one big reason, and it's precisely the inefficiencies that's where it comes from, which is kind of what we're trying to tackle, right? We're literally what we're trying to do, Randy, is provide access to all institutional investors out there to this asset class, right? Or what we call an asset class, which are these short-term rentals that we strongly believe, and data kind of backs this up, that can generate good returns long-term. Right. So that would be, in our case, I think the biggest reason. It's literally just information, inefficiencies. The information is not flowing well. And the folks that do have that information, that have access to it, they're not necessarily incentivized to provide access to the asset class itself to third parties, right? If they can, kind of capture the majority of the value creation from making those investments. In other words, you need somebody with access to information and with alignment of incentives, right? That wants to kind of provide access.
Yeah, and I think that's a great way to highlight, difference in true alternative assets that are providing the things we're looking for versus not. And that is, you mentioned it, are early entrants, probably sophisticated entrants with lots of advantages, either capital or access or both, making really outsized returns? Yes or no? If the answer is yes, then you have to ask a second question. And I think this is a really important one. And that is, are those outsized returns a function of monopoly or oligopoly power and or inside information, legal or illegal, kind of lowercase inside information? If the answer is yes for both of those or either of those, you have to be very cautious that this isn't an alternative asset class in which the average outside investor, if they can get in, can make money. But on the other hand, if it turns out that yes, early entrants, sophisticated players are making really great returns, but it's not because of insider information, might be a better mousetrap, but not insider information. And it's not because of monopolistic or oligopoly power, or at least that power is a moment in time. And if it were removed, it wouldn't alter the returns. If that's true, then it's a really great asset class to contemplate. And so certainly short-term rentals meet that definition. And most certainly unicorn, companies meet that definition, right? Venture capitalists have been making tremendous fortunes for themselves and their LPs over time, especially in that category. You pay a dear price at the earliest stages to end up with a stable of unicorns, like just look at Sequoia, but those unicorns provide such remarkable returns that it makes up for it and more. But that universe is very limited as to who can be in that. So I think that's an important way to think about it. Are early entrants or key players making a bunch of money? Why? If the answer is because they got access, then you should try to figure out how to get access and then build a derivative on top of it to have it match your needs. So, and we got a couple questions that are nice segues from that. So one question is, and this ties to this access quite a bit. What about like regulation in these spaces? Like how are alternative asset classes typically regulated? Is it more or less? So on average, the textbook answer would be they are much less regulated, perhaps unregulated, because they fall outside of the general scope of a lot of the regulatory structures. So they're neither equities nor bonds nor cash. So they're not in a bank. They're not being traded on a stock exchange, typically, probably not being traded on any sort of exchange, or if you're Coinbase or your other things, maybe someone's accused that of being an illegal exchange, right? But so they tend to fall outside of the regulatory structure. This presents a tremendous risk and an opportunity. And I wonder if you can comment on the real estate side. I'll make a comment on the kind of private market side. As it turns out, the buying and selling of pieces of private companies in the United States is absolutely regulated. It is, if they're Delaware incorporated, Delaware law applies as corporate law normally applies. The SEC has jurisdiction over these things. There are exemptions, there are opportunities to say, no, it doesn't apply. There's some things you can do, but it's absolutely regulated. So the opportunity is navigating that is a type of getting entry to a special club, and navigating it's hard, but if you can do it, you have access to stuff that is inefficient and you can make excess returns. But if you get it wrong, then the penalties are quite significant and can range from blowing up the investment itself to penalties and all sorts of things. And so you want to look for compliance oriented industries or opportunities. So nickel's definitely that private access to unicorns is regulated. And that's the opportunity, but you got to make sure however you're getting there is done correctly. So that's the opportunity on our side. What about real estate? Real estate, I don't know, real estate seems very Wild West to me. Maybe that's my misimpression.
Yeah, no, that's a good point. I definitely second what you're saying. So I think you want, this is our perspective. Our perspective is within real estate, and more specifically within short-term rentals, we like regulation. Interesting enough, we like when there's governing bodies on top of things. But how you get there, and perhaps more importantly, who gets you there, really, really, really important. In our case, short-term rentals specifically, it is a little bit of a Wild West, like all things considered. If you look at the average municipality, the average city, more often than not, there's no regulations that govern specifically short-term rentals. And most people think about the bigger metropolitan areas, right? Like New York, San Francisco, Chicago, right? Which are almost certainly all regulated already, both either like more positively or more in a more onerous way. It really depends. So choosing the right one and having access to that information, again, not easy, because nowadays there's no at least centralized, source of information of what are the short-term rental regulations in each and every little town, village, city in the United States, in the multiple layers of jurisdictions that there are. So you want to make sure that in my opinion, at least, that you're erring on the right side of that risk, because I don't think, personally speaking, taking on excess regulatory risk necessarily leads to excess return, right? I think it more often than not it's a bad risk investment, right? My personal opinion. Now, there's people that have made fortunes out of that, absolutely, right? And if that's what you're looking for, all right, but keep in mind that it's 1 every 10,000, right? So it's not, the odds are not good. So I think having access to those asset classes with teams with a lot of experience, like folks at Nickel, right? Or as I like to think, folks at Andy's, right? That can get you there with good fundamental rigorous analysis, pretty important.
Yeah, I think that's a great point, which we can kind of finish this question. There's one more that I'd like to tackle. If there is regulatory or absence of regulatory structure, that's a type of risk and a type of opportunity. If you go down that path, there are certain strategies where you can say, we've navigated it, it's settled, we're good. There are other strategies which are we're kind of feeling our way and guessing our way, and we think we've done it, but we're taking a gamble, but boy, that gamble's going to pay off if it works out. That's a very different thing. And I'm not poo-pooing that, but I would say that Andy's STR and Nickel are in the former category, which is it is tricky to navigate sometimes. In your case, you have to anticipate regulatory direction, hence you like it already there. In our case, we have to anticipate responses from several different agencies, notably the SEC and the Treasury and IRS, in order to get this right. But once you've done it, it's settled. I think you guys also used DLA Piper as well, but and for any DLA Piper listeners, yes, buy coffee, it's on us. You already got paid. So we spent a lot of time with DLA Piper and spent some time with Deloitte type Big Four accounting firms to make sure we got it right. I know you did the same on your end. So that's, I think alternative asset classes will have that. Private credit, for sure. We kind of live in a weird segment that might be characterized as private credit. I think we're better than private credit, and you're of course in real estate. So I think that makes a lot of sense to pay attention to. We have time for maybe one more question, which I want to segue to, and it's a good final question because it gets at this idea. Well, how do alternative asset classes, as we've defined them, how do they evolve? How do they change? When do they fall out of that category? And I do want to highlight that alternative asset classes can grow in popularity and they can draw in a lot of capital, and by that very function, the excess return or the better risk-adjusted rate of return that you were seeking can fundamentally be altered. There's no fraud or trick or anything going on here. It's just as capital flows into a fixed asset class and the capital becomes abundant, the rates of return on capital are going to go down. That's kind of just formulaic. So one thing that happens is if it's a very niche alternative asset class and it's small, let's say it's a $500 million or $1 billion or $3 billion opportunity, it hasn't been fully exploited. Once someone figures out how to get into it, over a fairly short period of time, your returns will drop. So that I think you have to be aware of, if you're getting into something, how big is it and how broad is the potential? And the other is you can end up with what I would call speculative bubbles, right? And there's been examples in real estate in the past, and there's certainly examples in private companies and others. So I would say on the nickel side, to get very specific, the nickel opportunity. So if you take the market cap of unicorn companies, the number bannered around is about 1,500. I would say it's probably closer to 1,100 really right now. People just aren't adjusting all their valuations correctly. So call it 1,100. About 10 or 11% of that market cap. That market cap is worth somewhere in the, let's call it $3 trillion range. You could argue 2.5 trillion, you could argue 3 trillion. Just for easy math, we're going to call it 3 trillion. So $3 trillion of private unicorn venture funded market cap. About 10 or 11%, we're going to call it 10% to make it easy. 10% is in the hands of employees or former employees who have vested options. I'm not talking unvested options. I'm not talking ungranted option pools. I'm not talking RSUs, but these are vested options, which are on the cap table, right? You have to put them on the cap table for full dilution. That 10% therefore represents 300 billion, give or take. It's a flow. So at any given moment, 10 to 20% of that should be serviced in the structure that we provide, because everyone wins. The company gets some exercise price. The employee saves huge taxes. They have shares, not options. Everybody wins. So in our case, it's a huge exploitable market. And yeah, in 5 to 10 years, if BlackRock, Blackstone, T. Rowe Price, CalPERS, Teachers on Terrace, if they all say, we want to write billion-dollar checks every quarter, okay, that you might actually start to fill up that space. But until then, it's like $10 to $30 billion a year of available investable capital. So there's a lot of room. Now, compared to some markets, that's not huge, but in the alternative asset class market that's accessible to regular people, that's big. How about Andy's STR? How big is your short-term rental kind of very clever niche that you've put in?
That's a good question. So in the US alone, most people don't know this, but there's 1 million short-term rentals already. Right. So that's a lot of short-term rentals. And each of them, there's a certain price. I think the average price is something like $400,000. So it's a sizable market. It's pretty sizable. But the interesting thing about this market is that less than 1% of the market is owned, way less than 1%. It fluctuates, but it's something like 10 beeps now. Less than 1% of the market is owned directly by institutional investors. Right. And that is very important because as opposed to what? It's basically mom and pops, people that have second homes that just rent them out themselves or through a third-party asset manager. It's not an investment per se. They don't see it in the same way. They don't need that information, right? And that means that the cost of capital there is significantly higher, right? Because it's people. It's people with higher cost of capital, with more uncertainty. And therefore, there is a gigantic space, like out of the 1 million short-term rentals that are here now, with capacity, by the way, by multiple different sources to get at least 5 million in the next 5 years, by the way. So it's a big shift, and that's in the US alone. Worldwide, the statistic is 20 million total and 50 million capacity. So getting access to that with institutional money or with like family office or investor money, gigantic space, right? Like values, estimates are like vary, but it's easily a multiple billion-dollar opportunity, like on the low end.
That's fantastic. All right. Well, we're out of time. So let me just kind of bring it to a close with a kind of quick summary, which is, the historic definition of alternative asset classes is anything that's not equities, not bonds, not cash. That leaves a very wide open field. So our practical approach is to say, okay, don't look at the classifications. Ask, what is it that you want? What is it that you hope to achieve? And what you hope to achieve is, a better risk-adjusted rate of return, and perhaps, either special volatility outcomes or non-correlation or something to do with, helping diversify your portfolio. That kind of tends to be what people are really looking for. And if you go with that attitude, a guidepost strategy would be look for inefficient but large enough asset classes or marketplaces that have fundamentals that allow, if you can select and do some smart things, to get really great returns. But they need to be big enough, and they shouldn't be an efficient market with a derivative slapped on top of it. It should be an inefficient market with certain features that we've highlighted in different ways, and perhaps with the derivative structure put on top of either cash flows that are super cool and optimized on the real estate side and short-term rental, or a prepaid variable forward contract, in our case, that allows you access to a really hard to get asset class. And once you do that, then you can evaluate your returns. And the last thing to check for is make sure it's not a one race story. Like, wow, look, it's $100 million exploitable opportunity and we're done. And then everyone crowds in and your returns go down. But rather, it's a runway with tens of billions of dollars of opportunity. Go back to our opening. The $24 you got the moment you sold the island of Manhattan. Yes, in theory, if all you got in 6% return, you could have put it in, you'd have, $38 trillion right now, but you'd have had to actively move it around, because anything that gave you great return over time would eventually become efficient and the returns would drop to nominal rates. And so whatever you do as you select alternative asset classes, ask the questions I hope that we highlighted, perhaps put some money in each of what we do, right? I think that makes great sense, but be active about it, because even great opportunities over time will revert to the return mean, because if they are great, and Andy's STR and Nickel are great, then eventually enough capital will flow in. We've got a lot of runway, but enough capital will flow in that your special returns and your special opportunities will fade. But in the meantime, exploit it. So we're glad everyone joined us. Really appreciate your time, and look forward to talking to everyone again. Sebastian, as always, a super pleasure to chat with you and hear your thoughts. And we'll talk again soon. Thank you.
Thank you very much.